introducing real estate broker, author, CEO, and founder of TrustedAgentUSA.com, the ultimate real estate matchmaker, connecting you with top-performing agents for 2% commission. Each week, we bring you exclusive interviews with industry experts, covering everything from staging to negotiation strategies to home inspection issues and everything in between. Whether you're selling your home, a first-time home buyer, or a seasoned investor, we've got you covered. Let's make your real estate dreams a reality in this fast-moving and ever-changing real estate market. This program is funded in whole or in part by Trusted Agent USA, Illinois license number 475-145-795. Now, here's Larry.
Welcome, everybody, and thank you for joining us again. This is the real estate radio show you are listening to. My name's Larry Shakman. I'm going to be your host for the next hour, and we have an amazing show set up today. We're going to dive into it in a second here. We have a very special guest, Randy Langenderffer. Randy is the president at InvestArc Properties, and we are going to be diving deep today on fractional real estate investing. So if you're a real estate investor, but you don't want to drive the bus, you don't want to be fixing hot water heaters and getting calls in the middle of the night with leaky roofs or anything like that, fractional real estate investing may be something for you. And Randy's going to drill that down for us. We have a lot of questions for him. Remember that real estate is a full contact sport. So you can call us or text us today with any questions for Randy or anything we're talking about at 773-763-9278. And we're happy to take your questions or talk about whatever you'd like to comment on. Remember that we are streaming live on Facebook at WCPT 820. We're also on YouTube, LinkedIn, and TikTok. Good morning, TikTok. We have a great show today. And remember, wherever you listen to your favorite podcasts, you could also listen to the Real Estate Radio Show podcast. So let's take care of a couple of things real quick here. On June 15th, we have a great guest, actually two guests coming up, and those are the managing partners over at Property Pals. Dane and Sam will be joining us. They always have a lot to talk about in terms of what's going on in the Chicago metro real estate market. And on the 22nd, if you're a real estate agent, you do not want to miss this. We have Joe Peterson coming on. He's the CEO of iList Tech, and he's going to show you how his product iList can really take your business to the next level while offering your clients just a lot more avenues to sell their home. So don't miss those shows. They are going to be fabulous. And we are going to be bringing Randy on in a second here. Before we do that, the market is very active right now. We have a lot to talk about. We're going to concentrate mostly today on fractional real estate investing because it's a very, very interesting topic and lots going on. As a matter of fact, speaking of investing in real estate, investor home purchases have increased for the first time in 2 years. Now, here's a stat that's kind of interesting. 18.7% of all home sales were purchased by investors. And that is very significant and really points to a lot of things. Now, a lot of that activity was in the lower price points. About 47.5% of all investor purchases were in the lower price point. So that's kind of an interesting stat too. But yeah, 18.7% of all home sales have been purchased by investors. So Randy may have something to say about that too. The U.S. job market added 272,000 jobs in May. that beat out all predictions. No one was expecting that. And I'm gonna guess that that's gonna put the Feds on hold when it comes to lowering the Fed rate at all. I don't see that happening. That stat points to the fact that the economy is still going strong. I do not see the Feds lowering the rate anytime soon, or maybe this year at all. We'll have to see. But that was a very, very strong figure that came out just a couple of days ago. So the last thing I want to talk about before we take a quick break and bring Randy on is let's take a look at our rates, because everybody's talking about interest rates. They always are. Everyone's looking at interest rates. You know, we all miss the 2.5%, 3% interest rate, which is never coming back again. Not in my lifetime, and I doubt for a while, if ever. But right now, the 30-year fixed rate is right around 7%, just a tad over, about 7.03%. FHA and VA loans, you can get a 30-year FHA or VA loan for about 6.5%. And same thing with a 15-year fixed loan. So really, interest rates, all of them are right around 7%. Like I said, FHA, VA, about 6.5, same with the 15-year. But the 30-year fixed is right around 7%, and that's where it's been for a while. I don't see it going any lower, and maybe even a little bit higher if the job market report keeps coming in hot like it did in May. So we'll keep an eye on that. We are going to take a quick 30-second break, and we're going to come back with Randy Langenderffer of InvestArc Properties and dive deep on fractional real estate investing.
Tune in to Real Estate Radio Saturdays at 9 a.m. hosted by the real estate therapist Larry Shakman, a top-producing real estate broker, author, CEO, and founder of TrustedAgentUSA.com. Top-performing agents for 2% commission, saving you thousands when you sell, buy, or invest. Real Estate Radio, the ultimate real estate radio experience. Get insider tips from experts throughout the real estate industry. Streaming live on Facebook at WCPT 820. Trusted Agent USA, Illinois, license number 475-145795. Welcome back to Real Estate Radio, sponsored in part by TrustedAgentUSA.com, the ultimate real estate matchmaker, saving you thousands. Now back to Larry, the real estate therapist.
All right, everybody, we are back, and we are joined by my friend and the president of InvestArc Properties, Randy Langenderffer. Randy, welcome.
Good morning, Larry. It's great to be here and great to see you again.
Yeah, absolutely. Haven't talked to you in a while. I know you've been on an extended vacation. Lucky man.
One of the advantages of full-time real estate is, my wife and I decided on May the 3rd, that was a Friday, we were going to take off for a 6-week hiatus starting Tuesday. And so, the advantage of real estate is you've got a laptop and a cell phone.
Yeah,
you're able to work anywhere.
You can take off whenever you want, but you're never really off.
No,
right?
No, that is so true. I mean, I live, as you know, in Houston, Texas today. I'm currently sitting in Cleveland, Ohio, at some relative's house, and found a quiet space to get away from the kid noise and all that. And but we're enjoying it.
I hope they don't mind you hopping on here with us today.
Not at all. It's been scheduled, so we're going to do it.
Awesome. Well, we have a lot to talk about. This is a very interesting subject, fractional real estate investing. And why don't you give everybody a little thumbnail on how you got into it, the transition into real estate, and how you got to where you are right now?
Well, happy to do so. And thanks again, Larry, for letting me join your show. It's a pleasure.
Yeah, love it.
I got started in real estate just about a decade ago. Maybe a little bit longer. I was working for a private equity company, a large Carlisle company, if anybody's aware of Carlisle, a spinoff of Goodyear Tire and Rubber. And this was in about 2012, and that time period when I realized I really needed to find another income because the old corporate gig wasn't going to last forever. I was afraid of losing my job, not because of performance issues, but because of the economy and I was an executive making a pretty decent buck, and that's always a bigger target on your back. So I had a brother-in-law who got me involved in flipping houses. We were hard money lenders. We lived in the Cleveland market and flipped houses in Dade County, Miami area. Did that for a couple of years. And then when I moved to Houston to find another job, another W-2 job. And at that time, I flipped a few houses there, hard money lended. But I really found multifamily at the time, apartment complexes. And I learned the value of syndication, joining large numbers of investors together to buy a property that I could never afford on my own. And I've fallen in love with it. And so that's what I do today. Primarily today, my sole job is I try to find opportunities to buy apartment buildings, large opportunities, apartment buildings to buy, and put investors together to go out and purchase them. Thus fractional, as you said. So you get a share of a 10 or a 20 or a $50 million apartment complex.
Yeah. It's funny because I posted a video leading up to this on TikTok about fractional real estate investing. And I think, some people misunderstand it and what it is, and we'll drill that down for them, give them a simple definition of that in a second here. But I posted this video and someone commented on it. Oh yeah, that's just like timeshare. What a ripoff. And I'm like, no, it's nothing like timeshare. And of course, it's probably somebody, a keyboard warrior that's never bought a timeshare or invested in fractional real estate, yet they're commenting on it. So let's give everybody a simple layman's definition of what is fractional real estate and why is it attractive to investors?
Well, so it's attractive, and this may be a long-winded explanation, but you asked for it, so
go for it. Absolutely.
It's kind of like you said in the intro, and the illustration I always give is you can be one of two different kinds of investors. The illustration of the airplane, the pilot in the front of the plane is the general partner, or he's the one that's got to worry, he or she's got to worry about air traffic control, the weather, the mechanical shape. He's got all the headaches of flying. Whereas the passenger in the plane, the limited partner, is the one sitting in the back of the bus, sipping their favorite beverage, reading a book, enjoying the ride. And they don't. That's a lot of people.
I'll let you handle all the problems.
And so we say the general partner has to deal with tenants, toilets, and termites. Tenants, toilets, and termites. And we hire property managers to do that. But anyhow, so the fractional piece comes. Let's just take a simple illustration. Say we want to buy a 100-unit apartment building in XYZ America. And, that 100-unit, let's just for simple place, costs $10 million. Well, I don't know about you, Larry. I can't write a $10 million check. I'm hoping the day comes when I can. But right now, so we go out and we take debt out of it. And we get, let's say we get $7 million of that $10 million in debt. We still need, just like buying a house, you need to have 30%, or say in that case, $3 million of equity, plus closing costs, plus rehab costs. So you're going to need probably $4.5 million. I'm not fortunate enough to write a $4.5 million check yet. So thus the fractional piece is we go out and we ask investors to come alongside us. It's called a syndication, and it's totally legal. It is not a timeshare. You own your share of, let's say, that $3 million raise. So if you put in $50,000, you own $50,000 over $3 million equity in that property. And the desire is that we can give you a healthy, substantial return, because we all know that real estate over the long term goes up. So as a passive investor, you can sit back and enjoy the ride, and we're going to give you a 6 to 9% cash on cash return a year. And we're going to shoot to double your money in 5 years. And so I tell people, if I can do that, would you be interested in hearing about it? Start the conversation there. So that's really the quick, correct me where I'm wrong on your audience, but that's the quick definition of a fractional investment.
Gotcha. So you are, let's say, on a $10 million property, just so I'm sure I have this straight, you will go into debt, $7 million. You're going to raise through other investors that other $3.5, $4 million you need for the equity you need to get that debt, and also any rehab and closing costs and things like that. Am I understanding that correctly?
You got it.
Okay.
It's
Interesting.
exactly spot on.
Yeah, it's funny how, people are confused about that, and somehow this one person anyway related it to timeshares, because no, you actually own a piece of this property.
Yeah, and I think the other differentiating factor I should mention, in a timeshare, and I don't own a timeshare, so I could be wrong, but
Good for you.
My understanding of timeshare is you own something of many properties. You can go any property. Well,
yes.
And here you own a specific asset in XYZ America, whether it's Chicago or Houston. It's a building. You can touch it. You can go look at it. Happy to give you a tour, et cetera. So there's a big differentiation too.
Yeah. I find it fascinating because I think there's a lot of people out there that this is a great fit for. Maybe an engineer or a doctor, or, has the money to invest, but they don't have the time to necessarily put into dealing with the termites and roofing and tenants and all that other stuff. And we've talked in the past, and you've told me about some things, because in real estate, things are always coming up. You're always putting out fires in real estate. It doesn't, nothing goes perfectly all the time, right?
Well, and you hit it on the head too. Real estate, be it, single family, multifamily, wherever that. So I am trained CPA, MBA, blah, blah, blah. It means nothing other than to say I took a lot of exams in life, but I didn't get this until much later in life that, I think the majority of people should have some of their net worth in real estate beyond their primary principal residence. Whatever it may be, whether it be single family or multifamily, whatever it is. And the example I always give is my last employer was a large academic medical institution here in Houston, Texas. And they had a 1.5 billion, that's with a B, endowment. And they had the traditional portfolio diversification of bonds and equities. But over the 10 years I was there, they really included 4 different asset classes today. They have equities, bonds, alternative investments, and real estate. So real estate is a separate line item in a $1.5 billion portfolio. And they had anywhere from 8 to 12% of their of that 1.5 billion in commercial real estate. So think about that. If it's good enough for the big boys, it's good enough for other people as well. And if you were to look at other large endowments, pension funds, they're always going to have a portion of their portfolio. I'm a little different in that I've got about 35%, 40% of my net worth in real estate. Okay, that may make some people feel uncomfortable, but that's fine. But high net worth people, not even high net worth people, there's people that you can get in this fairly easy if you so choose.
Yeah. I'm curious about something, because in the past we've talked about, some of the types of properties that fit well with a fractional real estate investing model. Apartment complexes, you have a build to rent, which we'll get into in a second here. Sam Rayburn, that build to rent in the Plano corridor, I believe, in Texas, and we'll get into that in a second. But I'm wondering, is it a good fit? Like, for instance, here in Naperville, where I'm in Chicago right now. I live in Naperville, but someone I know built a building, and it's all medical. It's medical offices in the building. And, I was thinking as I was passing it by yesterday that, wow, this would be a really good fit, I think, for fractional real estate investing, because, normally if a dentist comes in, or optometrist or whoever, and they rent out space in minimally it's a 5-year lease probably to start. And once they build their practice, they're never leaving. And well, in most cases. And I'm just wondering, is that a good, would that be a good target for fractional real estate investing, a building like that?
Short answer, yes, absolutely. And I don't know the specific building that you're speaking to, but I can almost guarantee that is a fractional investment. It just may have very few investors. It may have 3 or 4 high profile doctors, attorneys that own it. It may have a REIT owning it. But yes, there are many people that do that for all the reasons you just said. They sign leases, they sign them longer. They're going to stay. They're not going to, generally those leases have predefined rent increases in them over a 5 or 10 year period. And those are great. The only thing I would say is I like multifamily better than those commercial properties like that, because I say everybody needs a place to live in America, or at least right now. And so I think that differentiates it. Not everybody needs an office complex. Not everybody needs a strip mall or even an industrial warehouse. And so,
yeah.
To your point, I'm an investor of my own money in a syndication or a fractional investment. Warehouses, same thing. A group went out and bought multiple warehouses. So I still invest in other people's deals, and I'm a fractional investor in that for diversification purposes.
Now, when you say warehouses, are you talking about like those storage facilities? Are you talking more along the lines of large warehouses where they're, holding equipment and stuff like that?
Great clarification. They're both different asset classes and good asset classes. But my example, I was speaking about large commercial industrial warehouses owned by Amazon or somebody else that is along major highways for, as we move towards everybody's buying from home these days, and few people go out to retail malls anymore. Everybody needs a warehouse to ship to the last mile.
I know you're not investing in large malls. I know you're not doing that.
You're right.
Those are going the way of the dinosaur for sure, I think.
And who would have thought that? Who would have thought that? I wouldn't have, but we had a large shift in a paradigm shift with COVID and so. But I don't see a paradigm shift where people aren't going to live someplace. That's what I keep coming back to.
No, I agree. And like I said, we're going to jump into this investment property you have in a second here in that Plano corridor in Texas. And that is a build to rent duplex community. Am I correct? Or townhome community?
Townhome.
Okay.
Townhome.
Typically and how many units are in that investment?
So we're building 118 townhomes. They're they're very nice. They're going to be brand new. They're about 1,600 square feet. They have a 2-car garage, a back porch, a small yard with amenities that you would see in a typical rental space, such as office space, pool. The latest fad, we're putting in pickleball courts.
I saw that. I saw you're putting in some nice upgraded amenities in there that I think will attract a lot of people.
So that's the idea. You're trying to attract somebody that's more of a tenant or renter by choice than by necessity. In that vein, you're either going to get probably a young dual income family, or a boomer like myself who wants to downsize and get out of the burb and get into a nice unit that they don't have to do anything on. So there's advantages for both spectrums, but it's a growing trend. As you said, the people don't want a different experience than a 300 or 400 unit apartment building. Not bad. A lot of people need it, but it goes back to the fact that, depending on who you listen to, we're anywhere, I've heard as low as 3 million and as high as 8 million homes short in America. There's simply still an undersupply of homes for people to live in. And, I think that's what we're trying to meet and give some diversity.
How many, so in an investment like that, how many participants, for lack of a better word, would you have investing in that in a fractional manner?
So I think we're raising all in, I think $17 million. And so increments of 75,000 for that particular investment. So I don't know what's 17 million divided by 70. Many, let's just put it that way.
Okay.
60, 80.
And I know that one's pretty filled up.
It is. Yes.
Yeah.
We're coming down to the end of it. We're coming down to the end of it. So but that's the example of a fractional. So investors, again, don't have to be active or worry about all the construction and worrying about leasing it up and worrying about the tenant's complaints. You get a fractional share of the investment, and you get the rights to it. So you get distributions when we start paying them. As an investor, you'll get quarterly distributions, and then the plan is we generally don't hold these things for long periods of time, 5, maybe 7 years, and that part of Dallas, North Dallas, is just crazy growth. I'm from the Midwest, but even when I drive up there and check out all of the comps, and it's just crazy growth. And,
Texas, there's a lot of areas in Texas where real estate, like I don't think the Houston area is never not hot. That area is always like, and correct me if I'm wrong, if it's not that way now, but every time I look at Houston, anytime I've been there, man, it is just exploding. The real estate is crazy there.
It is true. And again, I heard these things, but until you visually see it, it's really, you don't grasp it. I give the example. I told my father one time I was driving. I live in Southwest Houston. I was driving to Dallas one Saturday morning. Told my father I had been driving for an hour and 15 minutes at 70 miles an hour. And I wasn't out of the city yet. So it's a big place. And so we're third behind Chicago. We're next behind Chicago. So I know Chicago's bigger in population, but I think it has a smaller land density, and Houston has a lot of land available.
And not as hot and humid, although it can get hot and humid in Chicago, but Houston is like the jungle, frankly.
There's some truth to that too, but I always say we don't have to shovel humidity.
Hey, that's true. Thank God. That's a good point. I'm curious because I was looking at rental markets around the country, and Chicago is like the number one rental market in terms of our rents holding up. Our rents here have actually gone up several percent, and we're like in Austin, rents have actually gone down about 4% in Austin. And I'm wondering, do you have any comments on that? Because Austin is a hot area. Austin is a great town.
I don't know the exact answer to that one. My speculation is that Austin's started to be overbuilt on it is the only reason for some of those minor declines.
Okay.
But the population growth has not stopped in Austin.
Yeah, that's what I was thinking. Austin is very, very popular. Great music scene, tons of restaurants. Just a great town. State
capital, a lot of tech coming to Austin.
Yeah.
The motto of Austin is "Keep Austin Weird."
Yeah. Right.
And I don't mean that disrespectful.
No.
That is just that's common knowledge. Keep Austin weird, because it is a very thriving, vibrant, growing community.
Yeah. Hey, we are going to take a quick break. We're going to come back. We're going to fire off 3 rapid fire questions at Randy, and then we're going to get into that Sam Rayburn development, because I want to talk a little bit about that, because you still have some spots available.
We do.
Yeah. All right. We'll be back in a sec.
Real Estate Radio, Saturdays at 9 a.m., hosted by the real estate therapist Larry Shakman, a top-producing real estate broker, author, CEO, and founder of TrustedAgentUSA.com. Top-performing agents for 2% commission, saving you thousands when you sell, buy, or invest. Real Estate Radio, the ultimate real estate radio experience. Get insider tips from experts throughout the real estate industry. Streaming live on Facebook at WCPT 820. Trusted Agent USA, Illinois, license number 475145795. Welcome back to Real Estate Radio, sponsored in part by TrustedAgentUSA.com, the ultimate real estate matchmaker, saving you thousands. Now back to Larry, the real estate therapist.
All right, welcome back, everybody. You are listening to the Real Estate Radio Show, and remember, you could find us wherever you listen to any of your podcasts. Excuse me, just look for the Real Estate Radio Show podcast. And we always stream live every week on Facebook, YouTube, LinkedIn, and TikTok. So check us out there as well. So today we are joined by Randy Langenderffer, who is the president of InvestArc Properties. And InvestArc Properties is a company that is into fractional real estate investing, which we've been talking about here today. And Randy has kind of cleared some things up, why people are confused and shouldn't be confused about what it is. And it's actually just a great opportunity for people to get into real estate investing without, as we said, dealing with the termites, tenants, and leaky roofs, and still profit from it as that investment moves on. And the end result, when you exit that investment, they'll also, take part in that as well, correct?
Hey, Larry, that's a great explanation. I just wanted to add one thing to that. You summed it up very well. The difference for the casual listener to who may be coming up with fractional investment is difference from single family housing, where single family, the property is evaluated based on the comps of the neighborhood, right? So you can either benefit from having an ugly house in a good neighborhood, or conversely, the bad way. But in commercial real estate, multifamily specifically, the values derive from how much cash the property is generating. So it's a business. It's evaluated on the cash flow, not the comps.
Good point. Yeah.
So for your listeners, another reason to invest in that is because of that. So I can increase the value of my multifamily apartment by either increasing rents or decreasing expenses. Thus, cash flow increases, thus the property value increases. We call it forced appreciation. So every opportunity we buy, we try to look to maximize revenue and minimize expenses. But it has a direct correlation to the value of the property versus the comps in the neighborhood of what other units are selling for.
Yeah. And, that's a really good point, because for instance, if you want to go out and get a DSCR loan, it really doesn't matter what your own personal credit is. If you bring to an investor, a hard money lender, or wherever you're getting your money from, a great opportunity, a great even a 4-flat or a 3-flat, rather than, these big complexes you're talking about. But an investor like myself looking to buy this 4-flat in the city, and it's completely rented out and it's producing this much cash flow, the funder is going to look at that more than they're going to look at your personal credit history, because what do they care about? They care about the deal.
The lender secures the loan based upon, and you hit on another very good distinguishing factor. The lender secures the loan based upon the asset, which is, I think commercial definition is greater than 4 units, or four units or greater. So your point, I can go out and buy a multi-million-dollar apartment building easier than I can buy a single family home, because it's based upon the asset and the cash flow, not the comps or even my net worth. Because the other thing about commercial real estate is, or apartments, not all commercial real estate, but apartments, if you can get a non-recourse loan. So this is what really attracted me. I can buy that multi-million-dollar asset, and it's secured by the property's income. And in the very worst case, if all heck were to break loose, if I were to default, the bank or the lender won't come after my personal assets, my house, my car. They would seize the property. I would lose my investment, but they can't come after me personally. And that's a big distinguishing factor than single family too. If I buy a single rent house, and I default on the loan, that lender can come back against other assets that I have.
Yeah.
Secure their principal.
Yeah. Yeah. I think that's attractive to, again, a lot of investors, because you're not putting your own personal butt on the line, for lack of a better way to put that.
Sometimes I can buy a 20 unit or a 50 unit apartment building. It takes as much work to do that as it does a 5 unit or a 10 unit.
Yeah.
In terms of due diligence up front. So thus, I just bought in early to kind of economies of scale, because that's why I got out of single family. I just couldn't get the economies of scale to work for, to own 50 rent houses or even 100 rent houses.
Oh man, that's a lot of work.
That's a lot of work. To own one apartment building, I've got a third-party property management company that does the day-to-day operations.
Yeah.
I've got full-time maintenance people on staff. And so it's a lot of work to get it. But after you get it, then we serve as the asset manager, where we oversee the property management, day-to-day operations and execution of a business plan.
So I was a large REO broker here in Illinois when all heck was breaking loose with REOs and foreclosures from about 2008 to about 2017, when it started to slow down. And now, of course, there's not many, there aren't many foreclosures on the market, certainly not comparatively speaking to back in the day then. Back then, it was 70%, literally 70% foreclosures and short sales on the market when everything melted down. So I would typically have about 500 properties in my inventory at any given time. Yeah, we had, I had like my savior out in the field. My field coordinator, Phil, would handle about 6 guys out there that would check these properties every day, deal with, squatters, everything else that was going on with those things. So I know when you tell me, owning 50 or 100 rental properties, even that is just an enormous amount of work for a property manager, or let alone a single guy owning all those properties. That's tough.
And again, when I looked at it, and I said, and then so you get a nice steady income, but the appreciation is sometimes based upon where the property is located, and the comps may or may not be as lucrative as me being able to force the appreciation in a commercial property.
Yeah. Yeah. So before we get into these rapid fire questions, give me, what's the avatar of the investor that gets into fractional real estate investing and starts working with InvestArc Properties?
That's a good question. The avatar investor is one, I think, I'd like to say I target people in their 40s, 50s, 60s that have some spendable income, even though there are many opportunities to get in this, but some spendable income that you're not taking their last dollar of investment. So, and somebody that wants to have real estate in their portfolio, and somebody that likes the advantages of real estate but doesn't want to be the pilot in the front of the plane. They want to be that passenger sipping their beverage and reading a book. So, and then I find a lot of people that after they become involved in it, they get the bug and they get the fever like you and I have had, and then they take off and they want to start buying stuff. And so we have a coaching business to help them find apartment buildings and invest in those as well.
Tell us a little bit about the coaching business.
Yeah, so I've had the privilege of being in this about 10 years. I've been in multiple different large national education groups. I call those the big box. They're expensive to join, and it's kind of like going into your Home Depot. They've got everything, but it's difficult to find somebody to talk to. So we tried to develop a multifamily coaching business, how to help people find it. That I'd say more is the True Value Hardware. That's a much more personalized approach. So when I walk into the local True Value Hardware, somebody greets me at the door and says, "How can I help you?" So we're much smaller. We only take about 5 students at a time. We're much lower price points. We have a large online curriculum, and we have weekly group calls to help them walk through, and a hands-on approach to it. It's very active. And so if anybody in your listening audience is interested in hearing more about that, I'll have an introductory offer of a month. If you come out, you can come on board for a month for only $197. If you reach out to me after this, would love to talk to you. But so there's Avatar, and then it's just a matter of how fast, how slow somebody wants to go.
So real quick, if somebody wanted to contact you and get into your coaching program, learn more about investing, see if it's for them, how are they going to do that?
They can get me on all the social medias, Facebook, LinkedIn, and the two primary ones I'm at. Randy Langenderffer, I'm out there. Invest Arc Properties. We have a webpage called Multifamily Maestros, all one word, multifamilymaestros.com. There's a discovery call on there. Email me. Happy to chat with you.
And is this coaching specifically to instruct people and give them a roadmap how to get into multifamily investing?
Correct.
Okay.
Correct.
Awesome.
So it's a niche. Folks. It's a niche.
Yeah. Awesome. All right. So rapid fire, Randy, what motivates you?
It's a good question. You're making me think this morning, Larry.
I am. I do that.
What I think what motivates me is I'm still I guess I'm still a capitalist. I enjoy making money, but at this season of my life, I'm really interested in helping others on their journey. Mm-hmm. So I'm still very engaged day to day, but I'd say what motivates me is helping others succeed as well. That's the emphasis for the coaching business, and we're trying to help other people come along, because this is a business that, somebody told me a long time ago, it's not brain surgery or rocket scientists. It's follow the playbook of those that have gone before you. Mm-hmm. And if you're willing to put in some work, you too can do it, whether you're a passive investor or that active investor. Mm-hmm. I think a lot of people, and helping people understand that. So I'm all about trying to build relationships, helping people come alongside of that journey. Spend a lot of time on the phone and the calls like this.
Yeah.
With people.
That's how we met.
Yeah, exactly.
Yeah, no, and I'm glad we did. And I think real estate in general is a great opportunity for people to, like you said, put a small or a fractional amount, no pun intended, of their expendable income into something that almost is always going to go up in value.
And you need it, to my mind, you need it in today's economy to average out the investments in your 401ks, et cetera, to get a higher return. Mm-hmm. So you're going to get a higher return, which averages your total portfolio better than the market. Because as an investment guy, I'd tell you, I still have a lot of mutual funds too, but many of them are just doing the market, whatever the market does.
Yeah.
And so when they go up, I go up. When they go down, I go down. Real estate's different.
Yeah. Yeah, exactly. So if you could give somebody one or two books that you've read that you feel will really help them in terms of getting the information they need to become a good passive real estate investor, what are those books?
The best one that I've read and I really like, and I've given away to people many times, to potential investors, is The Hands-Off Investor by Brian Burke. You can pick it up on Amazon for about $15. The Hands-Off Investor by Brian Burke. And he really goes into this whole fractional or passive investive in great detail to educate investors on what they're getting into. So that would be the other one. There's another passive income book by Anthony Vincello, I think it is, that I really like as well, because the whole thing we're trying to do here is get investors to get more passive income and to diversify their portfolio. And you never hear this from your financial advisor. I have one, still have one, but he's not incentivized to help me look at things like real estate where he's not compensated. So and that's nothing against him. But I grew up with with the attitude of diversification in stocks and bonds. That's good,
as most people do.
as most people do. But
Yeah.
you need some real estate in there.
Yeah.
Over the period of time, you're going to boost your returns, and they're going to do much better.
Yeah. I think, it's been said over and over again, but more millionaires and billionaires have been created through real estate investing than anything else. So, I mean, if you're serious about really, putting your portfolio on, auto drive and knowing that you're going to make money with these investments by and large every year. It's rare when real estate goes down in value. And particularly, it's attractive, the multifamily investment, because like you said, it's the value of that investment is not necessarily tied to where that single family home is, what was the last home that sold. And it's really all about cash flow. And you can control your cash flow with a multi-family investment where you really can't do that as easily with a single family home or even a build to rent single family home community, because they're out there as well.
Yeah, absolutely.
Yeah. So
I just let you talk, Larry.
No,
So great.
far be it from me. No, that's why you're
got
here.
it down.
So if you were, let's say you were able to look back, I ask everybody this question. If you were able to look back and tell your 18-year-old self, give them some really good advice about investing or just what you've learned through this path that you've taken, passive real estate investing, what would you tell your 18-year-old self besides get into it now?
Well, and you hit it on the head. I was much later in life. I got busy with career and got busy with raising a family. And again, going back, I wish I'd have heard about passive investing earlier because I'd have turned it over to somebody else. But the first and foremost is get started and take action. And so you say, because I know I was that way. I was kind of just, and so the key takeaways are, education, educate yourself. There's a ton of them. I'm an avid listener to podcasts, yours and others, where you hear about a ton of different topics. Read books, go to meetups. So educate yourself. And most importantly, I think it is, everybody wants to start out being Warren Buffett. Give yourself a break and just take the long view. Take the long view, be persistent. And over a long period of time, if you're in your 20s or whether you're in your 50s or 60s, there's still time to give yourself a break, be persistent, take action, and educate yourself.
Isn't that the truth, though? I mean, everything is about, of course, educating yourself, making sure that whatever you're going to do, you have thoroughly vetted it and you really know what direction you want to go in, regardless of whether it's passive investing or buying a 4-flat or, whatever you want to do. Take action. You got to take action. I mean, that is the number one thing. And you know what? It's sometimes the hardest thing to do because fear will stop you from taking action.
Yeah, and the one I say there too is it's you want to be an investor, and the difference between an investor and a speculator. An investor understands the risk and knows what they're getting into, versus, in my mind, a speculator just throws money at an opportunity because, hey, I heard Larry on the show and he was really sound intelligent and had a good track record, blah blah blah. Educate yourself so that you know what you're getting into.
There were a lot of speculators back in the REO days, man. There were a lot of people out there buying things up, and I'm not sure how much good information they had before they did that, but that was going on a lot back in the days of the REO and short sale meltdown. Hey, before we wrap up, I want to get into real quickly a little bit about the Sam Rayburn Townhomes, which is a build to rent townhome community in that Plano corridor. Give us some quick information on that and how people can get in touch with you if they want to get involved in that investment?
Well, I'd just love to talk to people again. If they invest, that'd be great. But more importantly, I just help them get in the list on my list for future investments as they come. But Sam Rayburn is actually in Melissa, Texas. It's 118 unit townhomes. As we said, their townhomes is different than the apartment complex, about 1,600 square foot. They got a two-car attached garage with a back porch and a small yard, which differentiate them well.
Mm-hmm.
It's Melissa, Texas is just north of Dallas, Plano. I think it's north of Plano, McKinney. It's right next to McKinney, Texas. So it's just unbelievable growth when I go up there. They built a $35 million high school football stadium.
Oh, really?
Is that crazy?
Yeah.
And so it's a very upwardly mobile opportunity. We're scheduled to be completed with horizontal, the land, the streets, the utilities in the fourth quarter this year, start vertical construction in January of 25. And that takes about 2 years to actually build and lease up. So at the end of 26, we're looking to refinance the investment and give people a bunch of their money back. But they can get a hold of me. Multiple things I said before, social media, Facebook, LinkedIn, reach out to me, either the multifamily maestros or InvestArc, INVST-ARC, invest-ark.com. There's a contact me on there as well. Love to chat with them. What's
the entry point of that particular
so today that's $75,000 is the entry point. There can be from a self-directed IRA or other available options for funding that. Subject of another whole conversation for your audience is using your self-directed IRA. That's how I got started.
That's our next show.
Let's do it.
Yeah. That sounds like a fantastic opportunity. And so if you guys would like to get into some passive real estate investing, fractional real estate investing, get in touch with Randy at InvestArc. There's a lot of opportunities out there, and Randy's been doing this a while. He's going to be able to really point you in the right direction, and you might want to get involved in that coaching program. Remember, knowledge is the key, and then you got to take action.
That's you hit it on the head, Larry. I appreciate the opportunity today.
Yeah, listen, we've enjoyed it. Thank you for joining us, and we will talk to you again soon.
All right. Thanks, Larry. Have a great day.
Okay, Randy. I'll see you. All right, everybody. We are going to wrap it up here. I want to thank everybody for joining us on the Real Estate Radio Show. And next week, be sure to tune in when we have Dane and Sam with us from Property Pals, and we'll talk about the Chicago metro market. We'll see you again next week.